And now I need to get back and find you the link to this upgrades page. Where did that go? There we go.
$85. Imagine you decided to buy a put option expiring in 18 days with a strike price percent below the current price, meaning you were betting that within 18 days, Microsoft would drop by 5% or more. A 5% drop from the price would set the strike at $270. Back then, this option cost $3.75 or $375 for the full position. But now, let's see where Microsoft stands today and what's happening. Currently, Microsoft is priced at $525, nearly double its previous value. Let's assume, just like in the previous example, that we expect it could drop by 5%. There's a small nuance here. In the first example, there were 18 days until expiration, whereas now there are 16. At the time of recording this video, no other expiration date was available, but this isn't critical because a 2-day difference won't significantly impact the price in this case. So, suppose we expect that within 16 days, Microsoft stock could drop by 5% or more, and we buy a put option with a strike of $500. Right now, that option costs $1.77 or $177 for the full position. Let me say it again. The stock is now twice as expensive as it was 3 years ago, yet you're paying $200 less for the same position. The reason lies precisely in implied volatility. 3 years ago, it was nearly 33%, while now it's just 18.5%. It might seem that now surely the market will never fall because if market makers keep lowering volatility, options will become cheaper, allowing more traders to afford them. This in turn means market makers will have to buy even more actual shares as a hedge, pushing markets even higher. However, this theory has two problems. The first is that when a stock price rises and volatility decreases, options do indeed become cheaper for you. You can afford to buy more options, and the market maker will indeed have to buy more shares. But since the stock has become more expensive, the market maker will have to spend more money. And despite having vast liquidity providing capabilities, there may come a point when liquidity starts to run short. To obtain it, they will have to sell previously purchased assets, which in turn leads to a spike in volatility, a rise in the VIX, and consequently a more rapid market decline. The second problem is that many people forget that the market maker doesn't actually have an obligation to constantly push the market higher. Figuratively speaking, they don't really care which way the market moves because they only make money on the commissions they earn from selling options. When the market maker acts as a stabilizer and reduces volatility, it means they buy on pullbacks and sell on rallies. During this period, the market exhibits a smooth upward trend with alternating downward and upward movements. This is exactly what we've been observing lately. Meanwhile, the VIX declines, barely reacting to intraday corrections, and traders feel completely at ease. But as soon as the trend begins to reverse, the market maker starts doing the opposite. They sell into a declining market and buy back during rallies. Volatility begins to rise, and each subsequent selling cycle becomes even more impulsive. To trade successfully, our goal is to align with the market maker's actions. We can track their positioning using the gamma exposure profile. This gives us insight into likely market movements and lets us peek into the inner workings of the market, a decisive advantage when making trading decisions. If this is your first time hearing about this, I recommend checking out the dedicated playlist on this topic. It covers everything in detail and will answer all your questions. But let's look at a couple of examples. In the Quant Power app linked below this video, the gamma exposure profile updates several hours before market open, giving you a strategic edge right from the opening bell. When analyzing the upcoming trading session, we determine the market backdrop, key support and resistance levels, as well as the levels toward which the price will gravitate. If the day starts in positive gamma territory, in other words, if the price is surrounded by blue columns, this indicates that the bulls will control the day. In such a scenario, we can identify an upside target, the largest values of positive gamma. If the level of maximum positive gamma also coincides with the peak absolute gamma, the level becomes even more significant, and you can confidently open a long position toward it. As for the nearest support level, we can highlight the gamma flip zone, the point where gamma shifts from positive to negative. This level will always carry special significance, and if the price drops to it, it will be an excellent place to open long positions toward the maximum positive gamma values. An example of such a day was Tuesday, August 12th. SPX opened around the 6,400
So we did not get the correct entry on gold.
Good
Um,
morning. This is Horizon's Middle East.
Stop taking out. I mean, a break even, but I was trying to go for this
After the deck to Iran,
buy opportunity long.
saying the
And
news is
so aggressive delta, aggressive buyers coming in and trying to target the
says is
IB mid level. Would have been perfect.
every week.
From here,
Oil is climbing on the deadlock, which
point trade, 80 ticks.
is rising. Meanwhile, Asian stocks whipsawing after calls.
We're getting a nice 2%.
We speak to the
Now
CFO
Q is right behind. CPI was released this morning.
following the attacks by Iran. Don't miss that interview at 8:40 a.m. Dubai time. Well, it's just gone 8 a.m. across the Emirates. I'm Giovanni Versace in Dubai. The latest being Trump's description of the ceasefire as being
I'm just looking for
support.
these trap sellers here on NQ, and now NQ is ripping up. Went right above IB.
The evening said that the ceasefire itself was
Yesterday's IB. We stay above yesterday's IB.
some doubt as
Stay above today's level.
raising the temperature for escalations in the region as we think about that upcoming Trump-Xi summit. Will they do anything before, during? Probably unlikely, but still, it really casts doubt on the state of that ceasefire right now. So the handover this morning from Asia Pacific, pretty negative, down 0.3%. But I wouldn't just say it's on back of the geopolitics. We had some really sharp moves in the Kospi. Ava will walk us through it in a second. But just to let you know, I thought this stat was very interesting coming from our M Live team. The Kospi saw $300 billion.
Now we're just going to wait for a swing back to midpoint to get an entry for.
Leaning towards negative, down about 0.1%. Today. So again, shrugging off the news coming out of the region. Brent not shrugging off the news from the region. We are up 0.9%, just shy of, well, just above $105. And then later on the show, we will be speaking to ADNOC Gas CFO. So stay tuned for that discussion around how energy markets are sort of redeploying given the closure of the Strait of Hormuz. And then 10-year yields back up again at 4.42. We moved a lot higher yesterday with that move in the price of oil, about 4 or 5 basis points higher. And then switching over our terminal charts of the day. And this is just a look ahead. We have US CPI data coming up. Obviously, a key focus for policymakers, for the Fed. And here, just to flag that there's been a bit of a gap between the shooting up in the prices of diesel, which are a key component when you think about transportation and travel. Logistics, but it has marginally fed into these CPI figures. So let's just see whether it shows up in today's data. Clearly going to be closely watched by some of those FOMC policymakers whose rhetoric has turned a little bit more hawkish as of late. Okay, let us now pick up the conversation about how markets in Asia are faring. Avril Hong is in our Singapore studio, and Avril, I perhaps gave a little bit of color around what's been happening in the Kospi today. Tell us more.
Yeah, a bit of a teaser there. Certainly, this is a market that has been front and center amid the AI rally, and it had quite a roller coaster ride today. At one point, as you say, losing $300 billion in market cap. And the trigger, the catalyst, was a Facebook post from a top Korean policymaker, suggestions of a citizen dividend for AI tax, which was later clarified to not be a windfall tax, but the damage was done. We saw the SK Hynix, the Samsung electronic stocks, these were stocks that were at records just a day ago, dip into negative, losing their most since early April. You're seeing SK Hynix now a bit in the green, but I think this whole episode has underscored a couple of things, including how crazy this rally in South Korea has been and the retail participation in this market. Of course, we also saw a bit of contagion in the Nikkei, declining into the red at one point. Again, that has recouped.
Maybe we should try a higher time frame.
The region, we didn't get clear signals of coordinated FX intervention to come. So we're seeing dollar yen moving even further away from the 155 handle. Jumana?
Avril, thank you so much. Avril Hong in Singapore. Now, oil is trading higher as U.S. President Trump passed out over the ceasefire with Iran after rejecting Tehran's latest peace offer and prolonging the effective closure of the vital Strait of Hormuz.
Life support is not a good thing, Deirdre. I would say the ceasefire is on massive platform where the doctor walks in and says, "Sir, your loved one has approximately a 1% chance of living."
Aramco CEO Amin Nassif says global oil markets are losing 100 million barrels every week that the Strait of Hormuz is shut. Meanwhile, as supply shortages bite, the U.S. Strategic Petroleum Reserve is providing just over 53 million barrels to energy companies to tame prices. For more, we're joined by Abid Abu Ahmad, our Deputy UAE Bureau Chief, and Stephen Zatinsky, who leads our energy coverage in Asia. Abid, I'm going to start with you. With the latest geopolitical news and the fact that President Trump is now casting doubt on this ceasefire, describing it as being on life support. How should we read these comments?
Yeah, good morning, Jemima. We just heard the president. He said the ceasefire that was reached on April 8th is on massive life support. He also said that, that the response that he got from Iran was garbage and that he did not even finish reading through it. So it's a particularly precarious moment for working are in the Middle East. Now, President Trump did tell Fox News yesterday that a deal is still possible, that reaching a solution is still possible. He did say that, he did not give an indication that we could see a return to a military intervention. Something that is quite important to keep in mind here is that there are two things facing President Trump. First is the pressure that he's facing domestically with the gasoline prices. You mentioned that, but also he's set to meet Chinese President Xi Jinping later this week. And the relationship here between the US and China is a little bit in tatters because of the economic damage that this war and the closure of the Strait of Hormuz has left on China. So the question here really is President Trump going to do anything in those few days leading up to his meeting with his Chinese counterpart? We're yet to see any signs of that. He did suggest also to Fox News that he could revive a plan to escort ships through the Strait of Hormuz. If you remember, that's
Project Freedom.
Project Freedom announced on Monday and paused shortly afterwards. So we're waiting and seeing mode yet again.
Wait and see mode, Abid. Thank you. Stephen, let's come out to you. And obviously, the effective closure of the strait is something that we've been talking about almost for 3 months now. It's pretty remarkable that it's been going on for that long. Some notable commentary coming through from the Aramco CEO yesterday. What did he have to say?
I mean, he said, as you mentioned, it's 100 million barrels of oil is lost every week. If you add up since the war began, that's about 1 billion barrels of oil. And we were going into a year where the oil market was supposed to be in a surplus and a glut. We had some great reporting on that at the end of last year about how we were going to see prices really continue to fall and how this is going to hurt major oil producers. Now it's the opposite. He signaled that it will take potentially until 2027 for the market to get back to where it was, to get back into balance. We're essentially seeing a year that could be quite a harsh deficit depending on how long this continues. And as we see, it depends also how quickly production can be increased from some of the world's biggest producers in the Middle East. He did signal that if the situation were to improve, they could bring back their output, pre-war output, in about 3 weeks, which I think did surprise some people in the market. I think some analysts thought it would take a little bit longer. To put that into context, Saudi Arabia is producing exporting about 7.4 million barrels a day. For the war, they were doing about 10. Their total capacity could reach 12. But they don't hit that because of the OPEC agreements on how much they produce and export. So I think that will be closely monitored, especially as these peace talks, if they actually do proceed.
Yeah. Okay. Abid Abu Ahmad, our Deputy UAE Bureau Chief, and Stephen Szynski, who leads our energy coverage in Asia. Thank you so much. Well, speaking of, higher oil prices are keeping bonds under pressure, while Iran risks are set to challenge the rally in global equities. Joining us now is Martin Henneke, Head of Asia and Middle East Investment Advisory at St. James's Place. Good to have you with us. I just wonder whether again, skepticism around the state of the ceasefire is actually going to have a notable global market impact, because what we saw was that April was a very strong month for global equities, particularly for Wall Street. And I wonder whether we've reached a point now where, what is happening in the region doesn't necessarily affect sentiment in other markets.
Yeah, that's a really great observation. You would have thought that perhaps yesterday's news and those very strong statements from Donald Trump might have led to a correction, a sell-off in markets, but it didn't happen at all. And, there's two things that come to my mind when I look at this. The first thing is that one has to question if some investors might be a little bit too complacent here, especially those that might be speculating for the short term, or have investors leverage or other forms of debt on the sideline. So I would just say, firstly, a word of caution. We would definitely recommend to try to avoid any form of leverage, and making sure that you have the ammunition and the staying power to hold positions for the medium to longer term, and don't rely on having those monies, on needing those monies in the shorter term, because corrections could come. Not only do the bond crisis not look too great, but the US as well. On the other hand, though, for anyone staying fully in cash, there is definitely this inflation risk coming through, which is a risk to cash.
Let me ask you what you think the best way to hedge is, though, because let's say you were one of the people that bought, upside protection on oil at 150, you'd be out of the money now. Similar if you had bought S&P puts.
Okay, look, when you look at protection, there's a lot of fancy tools in the market out there. In the long run, even when you look at equity portfolios, buying options, etc., or structure products, in the long run, it's seldom that investors have interest. One of the most simple ways of hedging is actually repaying your mortgage, for example. If you have one, a lot of financial institutions may not really advise that, though, because there's money on the loan to be made, there's money on other investments to be made. So just tidying things up might be a good idea. But I do want to say that ultimately what we are seeing most recently, the energy prices are feeding through into purchasing producer prices everywhere around the world. We have seen in China yesterday 2.8% producer prices, which was a real shocker. China has been in deflation for around 5 years, and that has helped keep global prices down. This may be ending, and this coupled with the very high debt loads in a lot of countries in the West. The US has so high debt load, they're struggling already with the debt servicing costs now. They're stuck a little bit. Even if inflation comes up, they may not be able to raise interest rates as significantly. Again, for savers, that could mean we are faced with rising negative real interest rates. Inflation might come up, but central banks no longer, unlike last time around when you saw this hike, no longer are able to stop it as easily by hiking rates. So on the one hand, I said, be debt-free. On the other hand, be mindful of not being overexposed to inflation risk as well. Have a significant portion of your assets in things that can protect from inflation, could be property, equities, or other assets.
Really interesting point there regarding debt, with I believe an echo of former U.S. Attorney Janet Yellen's comments regarding fiscal dominance. Let me ask you about how you think EM assets can perform in this environment. I mean, just taking a look at MSCI Emerging Market Index, it's been vertical the last couple of weeks, but that's, I guess, mainly to do with the semiconductor trade as opposed to other EM developments.
Yeah, that's a great question. I mean, to be fair, when you look back at 2025, a lot of EM markets were very undervalued, including Korea was very undervalued, and a lot of companies that have been doing really great. So I wouldn't say it's all a bubble, but early on the program, you were talking about how a lot of retail investors have been getting in. Of course, valuations have been rising, and also there's definitely starting to be some exuberance there. Now, what we would suggest is investors not only in the US, but now also in emerging markets need to be very, very careful about not being overexposed in sector terms to AI and tech, and look for value. Value stocks still trade at very, very low prices. They have missed a lot of the rally. Depending on which measure you look at, 50 to 75% relative discount will be brought in these things. And there could also be more prices resilient once fear might come in again if war could be not another time.
Martin, thank you so much for your time. Martin Henneke, Head of Asia Middle East Investment Advisory at St. James's Place. Now, coming up, the White House has confirmed U.S. President Donald Trump will meet Chinese President Xi Jinping in Beijing later this week. Tech, trade, and Taiwan, the three Ts, are all set to be center focus. And bring you a preview of what to expect next. This is Bloomberg.
Peter Piper persistently missed packages, so he scheduled his deliveries with Amazon Business. Peter Piper's pepper picking proved painful, so he ordered the supplies he needed from Amazon.
The White House has confirmed that U.S. President Trump will meet with Chinese President Xi Jinping this Thursday in Beijing. Trump says he will discuss U.S. arms sales to Taiwan with Xi, a move that could ruffle some feathers in Washington. For more, Bloomberg's Jenny Moore joins us from Hong Kong. Jenny, so Taiwan, obviously a very thorny topic, but are we expecting some form of a breakthrough between the two leaders this week?
No, I don't think we're expecting any breakthrough on Taiwan, but we will be watching whatever it is Trump and Xi say about that topic very closely. The wording on this matters really comes down to sort of the most subtle of nuances. Trump did say on Monday he's going to be talking about arms sales with Xi, which was surprising because the US is not meant to sort of negotiate on its arms sales to Taiwan with the Chinese, but in reality, this is sort of a big sort of tension. When they last spoke by telephone in February, Xi told Trump to take the utmost care on arms sales after the US announced its record $11 billion package to Taiwan. But Trump is sort of striking a defiant tone, so we don't expect to see any kind of reversal of policy there. But I'm sure officials in Taiwan will be watching very closely.
And who do we know is actually coming to the summit beyond obviously the two presidents themselves?
Yeah, the guest list is sort of been a guessing game, but now we have a good idea of it. Elon Musk will be on the plane with Trump, so it's suggesting that sort of relationship is back on between the billionaire and president. Then the usual faces, Apple's Tim Cook, who is a long sort of friend of China, is also traveling with him. You have the Boeing representative, which makes a lot of sense because Boeing is expecting to close this record deal, one of its largest sales in history, while in China. And then there is a more interesting name. So Meta Platforms, Gina Powell McCormick will also be flying. That's interesting given the fact that China has recently urged the unwinding of Meta's deal with Manus. So that could be something which comes up in these talks during Trump's visit.
Bloomberg's Jenny March, thank you so much for the reporting on what is going to be a highly anticipated summit later this week. All right, coming up, African Rainbow Minerals Chairman Patrice Motsepe praises public-private partnerships for keeping South Africa's mining sector competitive. Our interview's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. The chairman of African Rainbow Minerals has credited public-private partnerships for helping develop South Africa's globally competitive mining sector. Patrice Motsepe spoke to Bloomberg's Jennifer Zabazata at the Africa Forward Summit in Nairobi.
South Africa has got a proud mining history. All the countries in the world, whether it's Canada, whether it's Australia, whether it's South Africa, whether it's Brazil, we have to compete. And investments goes to those countries where they are world-class ore bodies, but also where the law, the financial, monetary, tax dispensation is competitive. So South Africa has to continue, and I think they've done very well in the last few years in ensuring that it remains a globally competitive destination for investment in the mining sector. Because the people who decide ultimately are the companies and the CEOs and And there were times when, you know, 10, 15 years ago when there were issues in relation to our global competitiveness, but I'm very proud of what has been achieved. And what I like even more is just the commitment and the partnership between the private sector and the government, because you need those partnerships. And part of what should take place in those partnerships is for the CEOs of the mining industry to keep telling the South African government what are the changes, improvements, and the areas that will ensure that South Africa is a globally competitive destination for investments. Well, for us in the mining industry, the first thing you do is to look where the best ore bodies are in the world. Highest grade, lowest cost. But you also look at the risk environment of those companies. What are the laws? Do they give confidence in terms of your long-term security of tenure, your ability to repatriate your profits? So I think over the last 30, 40, 50 years, to ensure that it bottom line and succeed in convincing the investors that they should open their next mine in South Africa rather than Australia or Canada or any other country.
That was the African Rainbow Minerals permit.
So gold just puked. We're below previous sources. When is this? We're below yesterday's IB. Did not displace past the high. We stayed below yesterday's IB and fell below today's. Came back below today, and aggressive sellers came in, and that's would have been a nice shorting opportunity. Yeah.
That lawmakers had made an error 4 years ago when they failed to establish an impeachment committee. So if it's empowerment was that dealt with the theft of money hidden in
Continue down the rest of the day.
Texas falls to stand down. And to look at equity futures as we head into the session, we are moderately lower. S&P futures down about 15 basis points. Nasdaq more so down 3 cents. European markets leaning towards negative as well, down 6 cents off at the Fed. Now coming up, we're going to take a deeper look at how the Iran war and the Strait of Hormuz disruption are reshaping Gulf economies with Hani Bayat from Jefferies International. That is coming up next. This is Bloomberg. Good morning. This is Horizon Middle East and Africa. Our top stories this morning. U.S. President Trump cast doubt over the ceasefire with Iran after rejecting Tehran's latest peace offer, saying the truce is on life support. It is prolonging the closure of the Strait of Hormuz, which the Aramco CEO says is costing global markets 100 million barrels of oil every week. Oil is climbing on the deadlock, which is keeping bonds under pressure, with global yields rising. Meanwhile, Asian stocks whipsawing after calls for potential AI dividends in South Korea. Plus, we speak to the CFO of ADNOC Gas, Peter Van Riel, later this hour on earnings following the attacks by Iran. Don't miss that interview in about 10 minutes' time.
We all want more progress, more wins. What we really choose is more life and more life games. The official fitness wearable of the PGA Tour.
30 a.m. across the Emirates. I'm Jumana Versace in Dubai. Let's get a check-in on how markets are faring. Amir Al Muhammad is in the studio with us to give us the check.
Good morning, Romano. Look, it's a subdued session when it comes to the U.S. futures image, down 0.2% this morning. Not a lot of reaction from the escalations that we're seeing coming out of the Middle East. A return to fundamentals, a return to the AI trade is still very much visible when it comes to the U.S. Now, we saw 2 days of rallies in the S&P 500. Picture is not great this morning. Now, the interesting story this morning when it comes to equities is in Asia. The MSCI Asia Pacific declining 0.3% this morning, both down by the prospect in South Korea. And this is an interesting story this morning. A top official in South Korea came out and said that perhaps South Korea should consider an AI dividend to citizens. That led to the cost of falling, dropping 300 billion in its value in 97 minutes. That's an estimate that was put through by our MIT, so that's reading on the overall index in Asia. And then when we look at Brent, it is the same story in the Middle East, but leading to an upside, gaining about 7.7% this morning, $104, $105 a barrel as the Strait of Hormuz remains closed.